Hi, and welcome to Evaluating ETFs, How to Choose the Right ETF in Every Asset Class, the latest in a series of educational webinars developed by IndexUniverse.com. My name is Matt Hougan, President of ETF Analytics and Global Head of Editorial at IndexUniverse. Along with my colleague Dave Nadig, Director of Research at IndexUniverse, I'll be your host for today's webinar. Dave and I are pleased to be joined today on the line by one of the smartest names in ETF research, Tom Guarini, Product Strategist for State Street Global Advisors, one of the leading providers of ETFs in the U.S. and abroad. The three of us have come together today to tackle a topic that is the core of everything we do here at IndexUniverse.com, evaluating ETFs. With more than 1,200 ETFs on the market, the task of identifying the best one in each area is daunting. We couldn't possibly cover every aspect of that task in a single hour. But Dave, Tom, and I plan today to provide a framework, a guidepost really, which you can use to do your own work evaluating, comparing, and selecting ETFs in your own practice. The format today is very straightforward. Dave and I will kick things off with a 20 to 25-minute presentation on how we approach evaluating ETFs here at IndexUniverse. In it, we'll cover some of the free tools we've developed that can help you get on your way and discuss the framework for how to approach ETFs in every area of the market. Following our presentation, we'll engage in a dialogue with Tom about a couple of key aspects of ETF analysis. Then, we'll open things up for audience Q&A. As a participant in this webinar, you can enter questions for either Dave, Tom, or I using the comments tool on your webinar screen. Please do not wait until the end to ask questions. Submit them as they occur to you. We'll collate the questions submitted throughout the webinar and answer as many as we can in the Q&A session. One final bit of housekeeping. For those of you attending this webinar live, you will receive an email 2 days following the presentation with a link to a recording of this session as well as full access to the slides. That email will also include information on how to qualify for CE credits, so look for that coming to you soon. With that, I'll get started. This is the goal of today's webinar, how to choose the best ETF in every area of the market. Whether that's large cap equity, small cap equity, commodities, short-term treasuries, Euro funds, or anything else, we want to provide a framework for how to make that decision. Importantly, this is a question that is deeply personal. There is no one best ETF for every investor. The best choice for you depends on your specific goals, time frame, and portfolio. Still, there are some guidelines you can use. And they're important, I think, to your bottom line. Here is a chart, for instance, of the worst performing biotech ETF in 2010. It returned about 2%. And here's the best performing biotech fund. For sure, you had a wild ride, up and down, but in the end, you gained nearly 37%. That's a spread of more than 35% in just 1 year. If you didn't know that ETF selection matters, you do now. And those aren't the only choices, of course. Everything else in this segment looks like some sort of blend between the two. We're not suggesting you can always pick the top line. Calling that spike in the early spring of 2010 in FBT, the First Trust Biotech ETF, which is the best performing on this slide, would have been akin to picking a single stock. In fact, there are plenty of investors who wouldn't even want that fund. Just look at the eyebrow-raising drop in 2010, and you can see that the fund took on significant risk. But the important takeaway here is that ETF selection matters a lot, and you can't judge a book by its cover. Just because an ETF claims to provide biotech exposure, you can't choose between different ETFs sort of without thinking about the differences of the exposure they provide. And it's not just something like equities where it matters either. In crude oil in 2010, you could have lost 1% of your money, or you could have been up 6.5% just by investing in crude oil futures. The actual price of oil, incidentally, was up 15%, but we'll get to that conundrum later. Even in a segment as well-trodden as U.S. financial stocks, the differences are huge. This chart maps the performance of 7 broad-based financials ETFs in 2010. It doesn't look at financial services ETFs or insurance ETFs or regional ETFs, but ETFs that claim to provide broad-based exposure to the U.S. financials market. And the difference last year between the best and worst performing of the bunch was 11.9% returning on the bottom and 22.4% on the top, a gap of over 10% in the same sector. Again, it pays to pay attention. By our estimate, there are more than 400 different areas of the market covered by ETFs, including more than 200 where multiple ETFs compete for your dollar. And the challenge of picking the right one is getting even harder. There are currently 1,214 ETFs on the market, and we've seen 121 new funds launch in this space alone this year, just year to date. That's a pace of more than one per day, and we're on track to set a record this year for new launches. We're currently tracking 795 new ETFs in registration at the SEC, so I wouldn't expect things to lighten up anytime soon. The truth is, ETF selection used to be fairly easy. There were a few dozen liquid ETFs and basically one consensus choice in any given area of the market. If it was U.S. large cap, it was the spiders. If it was China, it was FXI. If it was oil, it was USO. But today, there are solid alternate choices in each of those markets, and in some cases, better choices for individual advisors. So ETF selection is hard, and it's important, and it's something that every advisor needs to wrap their head around if they're going to be successful in the ETF market. So let's see how you do it. The first step in choosing an ETF is figuring out which funds deserve to be considered. And here, I'm actually going to pitch an IndexUniverse product. We don't usually do product pitches on these webinars, but I think I can get away with it here because the product is entirely free and downloadable for individual users on our website. We call it ECS, or the ETF Classification System. 2 years ago, we set out at IndexUniverse to develop a robust, repeatable system for evaluating ETFs, and this was the first problem we ran into. How do you decide which ETFs to compare? We searched around at all the available ETF screeners and didn't find what we needed. Some didn't have the specificity we needed. They say grouped all international ETFs together while we were looking to drill down to see which Indonesian ETFs they were. Or they missed funds, or they just followed an idiosyncratic method that we couldn't suss out. So we set out to build ECS, which we built as the first complete rules-based, hierarchical, unambiguous classification system for exchange-traded funds. It's designed to do something simple: divide ETFs and ETNs into distinct, non-overlapping buckets. And the goal is to make it easy for you to identify products competing in the same areas of the market and to pick the one you need. Think of it as the GICS of ETFs. So this is available right now on our website at www.indexuniverse.com/ECS, and I'll show you how it works quickly. At the core of ECS is our 7-tier classification system, which you can see highlighted in the left-hand side of your screen. Starting from the top, we start with asset class. Is the fund an equity, fixed income, currency, commodity, asset allocation, or alternatives fund? We then move into 3 tiers of geographic sort: development status, whether that's developed, emerging, frontier, or blended; region, which is essentially the continent of the fund; and specific geography, which gets as specific as you can be, whether that's California for a muni fund, UK for a country fund, or broad-based emerging markets for a fund that stretches across multiple countries in the emerging market sector. From there, we move into our 3 categories of exposure sort, which you narrow down specifically to the funds you want. This works differently in each asset class, but if you think back to a few of the examples from earlier, the biotech fund would be sector in the category space as opposed to size and style. The focus would be healthcare, and the niche would be biotech. An oil fund like USO would be energy on the category level, oil on the focus level, and front-month futures on the niche. For a bond fund, it might be corporate, investment grade, and broad-based. The idea is to drill down to as specific an area as you want. What makes the system unique, aside from the fact that it's updated weekly and is entirely rules-based, is that the 7 tiers operate independently. So if you're interested in China, you can toggle the China category and get both equity and currency plays. Or if you search for high yield in the focus category in fixed income, you'll pull in both corporate high yield funds and muni funds. There might be an interesting comparison there. Or in equity, you can look at Asia Pacific and then narrow down to the emerging Asia plays and then choose whichever emerging Asia country exposure you want. The system kicks out a list of funds and tickers and some core fundamental data, and you can download it into Excel with the push of the button. It's a nice little system, and as I mentioned before, it's free. So what do you get when you walk through ECS? You get a chart like the one I showed you earlier, which captures the 5 available biotech ETFs, not the healthcare ETFs or insurance ETFs or broad-based healthcare exposure ETFs, but biotech ETFs. So how do you go about from there to making an informed decision about which fund to choose for your practice? Well, we've spent the past few years coming up with a framework for evaluating all the critical aspects that go into an ETF, and that's what we want to cover today. The first thing we want to do is a little bit of a change-up. We all think that ETF stands for Exchange Traded Fund, but we want to tweak that to show up as different things: efficiency, tradability, and fit. In essence, each of those mean a little bit different thing. Efficiency means, can I trust it? Tradability, can I trade it? And fit, can I do better? Those are the 3 questions to ask yourself before you buy. I'm going to take a break here and ask my colleague Dave Nadig to walk through each of these areas of analysis as it pertains to equities. And then we'll take a quick run through the other asset classes as well before we open it up for Q&A. As a reminder, you can ask questions of myself, Dave, or anyone else by entering questions into the comments section of your webinar screen. Dave?
Thanks, Matt. So let's take a quick look at this first piece, which is efficiency. Can I trust it? And what I'm showing on the screen here are pieces of a product that we're developing, an analytical framework, an analytical product that we'll be providing out to the marketplace through the remainder of the year. And I just want to highlight some of the data points here. So when we're talking about efficiency, the question you're really asking yourself here is, does this fund deliver on its promise to me? Does a fund like XLF actually track effectively the S&P Select Sector Financials Index, which is the data we're looking at here? Do I gain access to that index's returns? Are there any risks? Are there any surprises? Many of the things here should seem obvious. Expense ratio obviously matters, so does tracking error. And if you look at this analysis of XLF, you'll see some interesting things. While the expense ratio in this case, for instance, is 21 basis points, over the past 2 years, the fund's actually lagged its benchmark by only 13 basis points. It's actually done better than its expense ratio. Performance is really only one thing to consider here, though. We also look at things like taxes and risk. So let's take something that's been hot and up and down in the market lately, like gold. Not everyone knows this, but gains on gold bullion, like GLD, are actually taxed at 28% regardless of how long you hold it. There's no such thing as a long or a short-term gain there. They never qualify for the 15% treatment. By comparison, futures-based products might get taxed at 23%, although it might lag the market if gold futures are in contango. Similarly, a gold ETN could qualify for 15% tax treatment under certain cases. So that's a 13% potential spread you have on your after-tax returns. So what else do we look at? Well, how about capital gains? Has the fund paid out significant capital gains in the past? That's often a sign that things are being managed inefficiently from a tax perspective. And what about the risks and rewards of something like securities lending? That's been a hot button issue lately. Does the fund lend just securities out? And if it does, are you as the shareholder getting the bulk of those proceeds back? Are you being treated fairly? Fund managers can make a lot of money for shareholders and for themselves by lending securities, but as an investor, you really should know what's going on, so you're fully aware of the risks and you're aware that you're getting a fair deal. You can read some of the other metrics we have here as well, but one note about fund closure risk. About 150 ETFs have closed in the last 12 months. Now that's not a disaster. People don't lose their money when a fund closes, but as an advisor, it's generally not a conversation you're going to want to have with your client either. It can create a taxable event for shareholders they may not want, and it has happened that occasionally shareholders get stuck with closing costs or unexpected cap gains distributions. But there are reasons that fund providers close funds. If they're small and they're losing money and they don't have the first mover advantage in the space, they're more likely to shut down. And that's one of the things that we measure here quantitatively is what's the likelihood that that's going to happen. Let's dig in a little bit on a few of the quirks here. Tracking difference and tracking error gets a lot of conversation in the press, and there's a lot of confusion about it. And it's one of the most important factors in efficiency, probably second only to expense ratio. Tracking error, formally defined, is the standard deviation of the daily difference in returns between the fund and what the fund's supposed to do, the index it's trying to track. And if you pull the data off your Bloomberg and you run the calculations, you end up with a chart like this, which is pretty noisy and pretty meaningless and pretty hard to actually get any insight out of. But if you calc the standard deviation of this data series and you annualized it, you do end up with a number. And in this case, for this fund, which happened to be the BRIC fund BKF last year, you get a number of 6.5%. But what does that 6.5% actually tell you? Really nothing particularly useful. It's useful to compare between two funds, but it doesn't actually give you any indication about your performance. So what we'll tend to look at is something a little bit more like this chart. This really tells you something about your actual experience. If I ask you how one of your investments perform, you'll generally say something like, I beat my benchmark last year, or I'm down 5% since I bought GLD. And that's really how we suggest people look at these funds as well when they're looking at tracking difference. Internally, what we do is we look at rolling 12-month periods, generally over the last 2 years, and we ask 3 questions. What was the median 1-year tracking difference? What was the worst case scenario? What was the worst 12 months I could have held this fund? And what's the best case scenario? And by looking at those 3 measures, you get a feel for how well that fund is truly tracking its index. And that's what this chart is showing, 12-month holding periods. And here you can see, well, okay, there were a few outlier times where I was a big loser versus the fund, certainly in the beginning. But in general, I'm less than 1% off. To be precise, you averaged a mean of 73 basis points in median tracking difference. To my mind, that's a useful number. On average, holders were about 75 basis points behind. That's a real number that's in terms people think about their portfolios. One word of caution here, don't fall prey to the shorthand of just looking at an annual return difference. It's really easy to do. Every provider has on their website something showing, for instance, that the index was up X% in 2010 and the fund was up Y%. But that can be terribly misleading because you're really looking at a point-to-point change. And there are definitely going to be periods when you're ahead and periods when you're behind. So you're much better off calculating these kinds of things on a rolling basis to really get a sense of how you would have performed. Let's move on to tradability quickly. Here's a place where almost all of the information you're probably used to looking at, certainly on the web, is wrong. When people talk about ETF tradability, they tend to focus on what we call primary or on-screen liquidity. That's the average daily volume of the ETF, the average spread, and for sure all of that stuff is important and should be part of the analysis. But if there's one thing we know, it's that the primary liquidity of an ETF, that on-screen liquidity that you're seeing on the tape, is really just a narrow and an incomplete view of the true liquidity of the ETF. All the time we see large trades go through on ETFs with seemingly tiny traded volume. We'll see, a 100,000 share lot priced right in the middle of the bid-ask mid for a fund that would normally only trade a few thousand shares a day. And it does this because at large sizes, the liquidity of an ETF is driven almost entirely by the liquidity of the underlying, the thing that the ETF is holding. And because an authorized participant can always make new shares, they can execute these very large trades at seemingly nonsensical prices compared to what the spread might suggest or what the average daily volume might. There are a couple of ways that you can try to measure that underlying liquidity. We've been developing our own in partnership with Knight Equity, but our basic suggestion is this: call the issuer. If there's a fund that you'd like to buy in size and you're not happy with the on-screen volume, you can often call the issuer or an alternative liquidity provider and you can ask for that execution, or you can ask for advice on how to get that better trade. For smaller investors, the liquidity you see on the screen is generally the liquidity you're going to get. But if you're trading in size, making that phone call is at least as important as looking at the spreads and the volume. So don't write off ETFs with less than X million dollars in assets. You generally can trade them. You're just going to have to be a little bit careful. We also think that looking at how spreads and margins change over time is an important thing as well, to get a feeling for what your worst case situation might be. So this is a chart that's looking at those 8 financials ETFs we were talking about during 2010. And you can see, and it's looking at the spreads that were reported in the market on a daily basis. You can see that most of these cluster at fairly tight, sort of sub-20 basis point spreads down at the bottom, but there is definitely volatility. XLFS, which now has a new ticker, PSCF, I think, is the small cap financials ETF, and it's no surprise that as a small cap fund, it's going to be quoted at wider spreads. But if you look at something like PFI, the PowerShares Financial ETF, that fund at times can look extraordinarily liquid, but then it can have these great big spikes. And in part, those were because of moves in that fund rotating into smaller cap names, which caused those spreads to billow out. So it pays to look at different time periods to really get a sense of the true tradability of an investment. One last quick note on tradability. One of the things that people get most hung up on about ETFs is premiums and discounts. There's a lot of noise about this. On pretty much every fund issuer's page, you can see a daily measure of the premium and discount of a fund, you know, how that fund has traded versus its real underlying net asset value. And we all count on ETFs to track their underlying values perfectly, and they don't always. So premium discount is that measurement that tells you how you're doing. Unfortunately, it's almost always wrong. The way people calculate and report premiums and discounts is to compare the closing price of the ETF at 4 o'clock in the afternoon when the market closes with the net asset value of that ETF's underlying portfolio. Now, this can work great, right? When we're talking about something like SPY, the S&P 500 spider, the fund closes at 4 p.m. Every single thing in that fund also closed trading at 4 p.m. You can make a very clear apples-to-apples comparison. But what about something like GXC or any other China fund? You know, they trade all day in New York. The underlying securities don't trade at all. So when you compare the closing price of GXC to its closing NAV, they differ wildly. But that doesn't tell you anything about GXC except that it happened to be trading in New York, which unless you've been asleep for the past 10 years, you probably already knew. This chart, for instance, compares the price of GXC versus its intraday indicative NAV indicated in red. And if you look at that upper right-hand corner, you'll see GXC trading all over the place, and the INAV goes flatline. And that's not an error. That's the year of the rabbit. That's the Chinese New Year, and all the underlying stocks were closed. So the point here is there's nothing wrong with GXC here. GXC is actually doing its job very nicely. My concern is that premiums and discounts are often being looked at incorrectly, and more often than not, at least for international securities and often things like bonds and commodities, these premiums and discounts are a false measure and can often, frankly, be ignored. So let's move on to the last and perhaps most interesting part of the way we approach analyzing ETFs. The first two things we talked about, efficiency and tradability, were highly statistical, very impersonal, very much based on the facts. You know, can I trust it? Can I trade it? Those are pretty binary answers. You can either answer yes or no, and if you're not going to answer yes to those questions, you're probably not going to consider the fund. The third piece, fit, is much more subjective and it's much more personal. And the way to think about this is, can I do better? And the answer is almost always going to be, well, maybe. It's often not the case you're going to be able to say with absolute certainty, yes, I can do better than this fund. If there's one thing that we've seen from all those screenshots before, all those charts, it's that ETFs deliver very different patterns of returns. And you have to understand which one you actually want. I mean, it's easy to say in retrospect you want the one that performs best. And it used to be that the indexes were very simple to choose from. The S&P 500 and something like the Russell 1000 rather, they differ, but they're providing pretty similar patterns of returns, and people aren't going to get wildly off the mark by, say, ending up in Russell instead of being in the S&P 500. But the ETF revolution has sparked this huge diversity in kinds of indexes that are available. Equal weighted, revenue weighted, fundamental weighted, AlphaDex, dynamic, FTSE-RAFI. I mean, it can really make your head spin. So how do you compare these kinds of exposure? Well, it really comes down to looking at the tilts inside the portfolios. The way we do this internally is we select, anytime there's a competing ETFs, we select what we consider a neutral benchmark in every part of the market. Not because we think the neutral benchmark is always the right thing, but because you have to have a yardstick that's got marks on it. And so we pick a neutral benchmark to be our yardstick. We then compare how every fund in a given market compares against that yardstick. So if you want financials, you need to know what the market portfolio of all financial stocks looks like. And then you can see whether or not the ETF is different than that market portfolio, and you know what kinds of tilts you're taking, what kinds of risks you're taking. So there's two ways to get at this when you're doing your analysis. The first is the most labor intensive. To really understand the difference between, say, XLF, the largest financials fund, and the totality of the U.S. financials market, you really do have to get in and look at each holding. How much of the market does XLF hold? Does it skew higher cap or smaller cap? Is it overweight banks or insurance companies or REITs? You know, is there a difference in price to earnings ratio or dividend yield versus that market portfolio? How does it break along regional or country lines if it's an international fund? And that's just frankly a lot of work. The second way to understand fit is to simply look at returns over time. So in our shop we do this with regression analysis, so we wrap modern portfolio theory statistics around the difference in returns between that market portfolio and the target ETFs. And we measure whether or not the tilts that that fund has made away from the market have been rewarded with better risk-adjusted returns. So you can do this analysis by taking a lot of time and tons of data, or you can frankly do it by looking at how the various alternatives have performed during various stress test times. It's less academic, but it does get to the same point. You know, are the fund tilts paying off, say, during a downturn or during a crisis period like in 2008? How is it performing when, say, small caps have been rewarded? You know, it helps you get a picture of what the ETF is actually doing with your money in a fairly quick way, that kind of regime analysis. Now, if you don't have a specific opinion about a sector, let's say if you just want exposure to finance, but you don't really have a particular opinion about banking or insurance or mortgages or REITs, you know, in general, we recommend that people buy the broadest market cap weighted index available. But if you want to be more sophisticated and you really want to express a view, you really do need to dig down into the portfolio and choose the specific exposure that you're looking at in the selection universe. So that's the kind of data that we're looking at in something as simple, with big quotes around it, as equities. You know, first we use our ETF classification tool to make sure that we're looking at the right list of funds. Often that's the biggest challenge. And then we push all that data through the filters of efficiency, tradability, and fit. But of course, some of this analysis really changes when we look at different asset classes. So we're going to take the next 4 or 5 minutes here and plow through a couple of these, and then we're going to open it up to Q&A. Let's talk about fixed income first. When you're evaluating fixed income ETFs, probably the most important thing to recognize is how big the bond space is. Bonds indexes can have thousands, sometimes tens of thousands of issues in it, as opposed to the few thousand stocks, for instance, in the U.S. market. And many of these bonds, frankly, never trade after issuance. They get issued, they get bought in their entirety by institutional investors, and then they go off the market. But they're still in these indexes. Other bonds are just simply illiquid and hard to buy. They don't trade a lot. So as a result, fully replicating a big bond index is often impossible. And so fixed income ETFs, more often than not, are heavily optimized. They hold a sampling of their underlying index. Often the easiest way to see how a fund is doing this is simply look at the number of holdings and see how much of that index is being tracked. So for example, this table looks at 3 ETFs aiming to track the Barclays Capital US Aggregate Bond Index, the old Lehman Index, and knowing nothing else, you would expect that BND on this list, which holds close to 5,000 securities, is 6 times more than its nearest competitor. You would expect that that would probably do a better job staying tightly tracked to its index, which has 8,000 securities in it. But however, there are advantages to optimization. It can lead to better trading and liquidity, and you can theoretically get outperformance. So on the next chart, we're looking at those 3 funds since the inception of the earliest one, which was in 2000, or the latest one, which was in 2007. And indeed, while BND tracked its index better, it hasn't actually been the top performer in this case. The top performer has been the State Street Fund LAG, L-A-G. Now, the difference isn't enormous, and you wouldn't really expect it to be. It's been a bit under 2% in 4 years, but that's 2% that personally I'd rather have in my account than not. Now, that doesn't always mean that it's going to be the outperformer. It's a question of how well they maintain that optimization. But it's important to recognize there's almost this little hint of active management that has to come into play when you're dealing with bonds, because you just can't buy them all. You also have to look, when you dig into FIT, at very different things. We're not now looking at things like small cap and large cap. We're looking at things that really drive bond returns, things like interest rate and credit risk. Things like duration, for instance, which measures a bond portfolio's sensitivity to shifts in the interest rate environment, something we're obviously all very concerned about. You know, a portfolio that deviates from its benchmark in terms of duration will respond differently when interest rates change, and that's going to create variance to the returns you expect. You know, we tend to look at effective duration or modified adjusted duration, and that's quite often what you can find on an issuer website. We also look at yield to maturity, which gives you a sense of how far out that bond fund is investing. You know, and you as an investor need to decide whether you want to take these tilts against a market benchmark. Do you want to be going longer than the benchmark? Do you want to be getting more interest rate sensitivity? You know, in credit risk, obviously people focus more on this in the corporate space, and it can be quite a challenge to get apples to apples comparisons here. Many issuers report different kinds of data. You may see Standard & Poor's ratings on one website and Moody's ratings on another website. The irony here is that many investors who don't dig under the hood assume that all bond funds are equal, but at the same time it can be very difficult to get the good portfolio information you need to prove that that's not the case. Let's take a quick look at commodities. You know, this has been the darling of ETF investors for the past few years. Probably more ETF headlines have had to do with gold and oil and agriculture than any other category. But even defining what we mean in commodities can be a challenge. Investors looking for, you know, a big, broad commodity index need to realize right off the bat that there's just no consensus about what that even means. There are popular commodities indexes, but proving that one's better than the other is going to be a real challenge. You know, this table looks at the 4 most commonly tracked indexes. The one on the left, the S&P GSCI, 65% in energy right now. The second most popular here in the ETF space, which is the Dow Jones UPS, only has 34% in energy. Obviously, that distinction in a market with volatile oil is going to make more difference to your returns than anything else that's going on. The old saying goes, there's no market cap for wheat, and picking the wrong index here for a given period of time can really make a difference. Perhaps even more important is actually understanding what you're investing in the commodity space. We mentioned earlier that the best performing oil fund in ETF land was up 6.5% in 2010, but the price of oil was 15%. Well, the reason here is that with the exception of precious metals, ETF investors aren't actually buying commodities. They're buying commodities futures. And commodities futures are a tricky beast. You know, sometimes they do better than spot prices, where you can buy your future exposure cheaper than spot. But more often lately, you pay more than the spot price to get your exposure, and you suffer a slow erosion as that future comes due. That's a situation known as contango. So these little charts here show the difference between spot and futures on 2 popular ETFs. And on the left, we show natural gas, and you can see that depending on how far into the future you want your exposure, you're paying substantially more than the spot price of natural gas to get your exposure. This has been a persistent problem in natural gas, and thus the most popular natural gas fund, UNG, has underperformed spot since inception by a staggering 54%. And in something even as tame, people think, as corn, we've seen a similar situation. You know, corn prices skyrocketed in the last year, but investors in the ETF have only managed to capture about 2/3 of those returns. It really comes down to knowing what you own, probably more in commodities than in any other corner of the market. I'll hit a couple other ones quickly. In currency, it turns out that structure is actually probably the most important issue you could make. If you want to get exposure to something like the euro, 3 very different strategies here. Something like the RIDEX currency shares funds, they're grantor trusts. and what that means is they hold currency in foreign bank deposits, and they get paid interest, and that monthly interest that you're getting gets taxed to you as the investor at ordinary income rates, and any sale from the ETF, whether short or long term, is also going to get taxed at ordinary income rates. There's really no way to get preferential treatment on those gains. The Wisdom Tree currency funds, on the other hand, are registered like 40 Act funds, pretty much like all equity ETFs. And these funds hold forward contracts, collateralized. And as with grant or trust, if they throw off income, you get taxed normally, but the long-term gains, you might get preferential tax treatment. And then last, you get things like the ETNs, like ERO, and these are fundamentally just debt, obviously issued by Barclays Bank, promises to pay the return on a day-to-day change in spot currency. But in this case, the gains from those overnight interest rates are just embedded back into this implied value of the fund. Now that sounds fine, except that you still have to pay taxes on that, even though you didn't get a check. So you're going to be paying taxes on essentially reinvested dividends that went back into your investment, whether you got that distribution or not. And it's not just structured either. Each of these funds gets at their currency exposure in a different way. You know, some funds really just hold short-term debt, making them much more like a money market fund that happens to be in a different currency. Investors really need to dig below the surface in currency to understand all of the issues here: tax, counterparty risk, and the real pattern of returns. Let me hit a few sort of favorite alternative categories before we open it up. The most challenging corner probably of the ETF market are these one-off attempts to provide sort of counter-market exposure. By far the most popular is the volatility products tracking the VIX index. People use these funds to try to express a view on the volatility of the S&P 500, often to hedge exposure to the S&P 500 itself. But because the VIX index itself isn't investable, kind of like it's difficult to own a bushel of corn, these funds have to invest in futures. They invest in VIX futures, and those VIX futures are most often in steep contango. And so consequently, you end up with often quite different performance. Over the past year, on the next chart, you can see that VIX is down 40%, but VXX, the ETF that tracks it, is down a staggering 76%. Now that doesn't make VXX a good product or a bad product. It's generally doing exactly what it says it's going to do. It's investing in VIX futures. But it does mean that you need to think about this as a long-term investment, and you need to know exactly what you're buying going in. It's a similar case for so-called absolute return products. These are hedge fund style strategies that have lower correlations to major asset classes. At least that's what they're trying to do. There are more than a dozen absolute returns that are trying to provide these kinds of strategies. But in general, the thing you're trying to do when you're looking at fit for these things is actually make them, to find the ones that look least like anything else. So where we might have been looking to try to find funds that match a market portfolio, here in the absolute return space, we're actually looking for the opposite. We're looking for the things that are as different as possible. So we picked one just for a couple charts. This is the DBB Currency Carry Fund. It's designed to capture the traditional currency play of borrowing at low interest rate currencies and investing in high interest rate currencies. And you can see on this chart it's trailing the S&P 500. But in this case, this might not be as off-putting. You're actually looking for something that's different, so it is a little bit different here. But you would look at this and say, well, what's the correlation? The correlation here is 67. That's actually quite high. However, if what you're trying to do is hedge your bond exposure, you run that same chart against the Barclays aggregate, and you're showing negative correlation of 36. Is that a diversification benefit for you? That's going to be up for each ETF investor to decide. And that really brings us back full circle. You know, if exchange-traded funds are really all about capturing different patterns of efficiency, tradability, and fit, it's not the case that any one ETF is going to be right for everybody. A short-term trader might arrive at a very different conclusion than a long-term investor, and we've been through a few examples of that. But at least with this framework, we think you can begin to tackle the problem directly and really start making better decisions for your clients. So with that, I'm going to turn that back to Matt. Matt, you still there?
Absolutely, Dave. Thanks so much. That was a great presentation. We certainly covered a lot of ground. I want to remind the audience that they can ask questions of Tom, Dave, or I using the comments section on their webinar page. And with that, I'd like to bring in Tom from State Street Global Advisors to discuss a bit on how he thinks people should evaluate, research, and consider ETFs. So Tom, I had a general question for you. I mean, Dave and I just covered a great deal of ground. You've seen how we approach the ETF space and all the things we look at. From your perspective, what's the most important thing? Where should advisors start when they're comparing ETFs?
Sure. Thank you, and thank you for having me today. While there's many things to consider, I think when evaluating an ETF, you look at the provider, you look at the total cost of the ETFs, the expense ratio, bid-ask spread, premium discount. These are many things that you touched on in your presentation. Also the tracking error. But if you look at the construction and the methodology of the underlying index, and which is something that I believe is very important and a really good place to start. So if you look out within all of the indices, if you look at these, most of those are market cap weighted. Some are price weighted, fundamentally weighted as well, and these include dividend weighted indices, as well as equal weighted indexes. So while each of these may have their merits, it may be a little bit confusing for the end buyer of the ETF. So if we look at an example of that, we look at the standard mid-cap SPDR S&P mid-cap 400 ETF, ticker MDY, and that's based on the S&P 400 index, which is a cap-weighted index. But when we compare that to maybe some of the dividend-weighted mid-cap funds that we see out there in the mid-cap space, you may get exposures to things that you may or may not want. So you may, within the dividend space, you may have overweights in financials and utilities, or that fund may have a value tilt to it as well. So often these differences can translate into significantly different performance results. So for example, Dave, you had mentioned our S&P China ETF. If you look at that index and you compare that to the FTSE China 25 index in 2009, so for 2009 you'll see the S&P China BMI index performing at 69.95%. If you look at the FTSE index, that had a return of 54.23%. So big difference there, big spread between those two indexes. If you fast forward to 2010, we see similar results. S&P China BMI index returned 9.18%. The FTSE China 25 index returned 3.15%. So again, we see a spread there of more than 600 basis points.
Right. So Tom, those are kind of, I wouldn't say they're easy to understand. They're certainly difficult to predict, right? I mean, on any given Sunday, one collection of stocks can outperform another. We've actually had a couple questions come in that I think feed right off of this. Right? We've talked a lot about index selection, but how do investors look at, say, 3 or 4 funds that are all tracking the exact same index, right? They're all, I mean, we hit on this briefly with bonds, but let's think about it in the equity space. Something as simple as the S&P 500, investors have 4 or 5 different choices. What makes these funds different provider to provider? What should investors actually be looking at?
Well, I think you touched on that quite a bit within your presentation. Are they optimizing? Are they providing the exposures that they should be providing? So the end result here, I think, is what you want to do is you want to track the index. So however you do that and however best you do that, when we're talking about an S&P 500 fund, the underlying securities are very liquid, right? So the ability for a manager to be able to manage that index and track that index should be pretty straightforward. When you're talking about fixed income or some of the more esoteric spaces within some or different asset classes, that can become a little bit more difficult, and a lot of those spaces use optimization. So
absolutely.
I mean, I would say, like, as the manager manages the fund, for instance, SPY is fully replicated, so it tends to track that index very well.
Let's go outside the sort of traditional size, style, and country boxes, where I think we all at least have a common frame of reference that we can compare these funds back to a market cap weighted index. You know, we get a lot of questions about dividends, and certainly the dividend-seeking funds have very different methodologies. How does an investor make a rational choice between competing dividend products? What should they be considering? Can they just buy any one of them and expect it to deliver the same pattern of returns as the next, or what statistics should they look at?
I think that's a great question, and you know, to start, I think many of the metrics that investors should consider in a broader sense, and some of the questions that we've covered in some of the material that we covered here in more of a broader sense should be asked of any ETF. Again, some of these include the ETF provider, their commitment to the business, their total cost of the ETF, including expense ratio, tracking error, et cetera. But I think in this case, and we did talk about some of the underlying indexes, and speaking specifically for dividend funds or other fundamentally driven ETFs, the index construction, I think, is especially important in making that decision and choosing one ETF over another. So I believe this because I think there are maybe details of the index that could or would play a key role in what type of exposure you're looking for. So for example, the underlying index for our SPDR S&P Dividend ETF, ticker SDY, that index is the S&P High Yield Dividend Aristocrats Index, which that index demands only companies that will grow dividends on an annual basis for at least 25 years, and those companies are eligible to be within the index. Now, this stringent rule applies to SDY in this space, but other ETFs may have less of a stringent rule. It could be 5 consecutive years or 10 consecutive years. So again, I think the details of the index in this case, and we're talking about fundamental or dividend-weighted index, are very important.
So let's stop grilling Tom for just a second here and answer a question here from the audience, which I think is a really interesting one. And Matt, I'm curious what your thought is on this one too. Are there any classes of assets or any corners of the market that don't have ETFs yet that should? And maybe Matt, let you answer that one first, and then we'll let Tom pile on.
Yeah, let's all go around in a circle. Well, I think that is, you know, that's a hard question, right? The first big white paper that came out that said ETFs had covered the entire market came out in 2002, and we've certainly learned since then that there was more space than that. I look through it and I see obvious holes in fixed income in terms of providing access to all the different places on the yield curve in all the different slices of the fixed income market. There are definitely some short-term and intermediate areas that just don't have a fund yet. I also think we'll continue to see better funds in certain areas of the market. So I think there's room for better funds in fixed income. I think there's room for more non-market cap weighted funds in fixed income. I think there's room for better funds in commodities. I think that industry and asset class continues to mature. And then, you know, just generally, I never doubt the ability of people to be more creative than I. So I'm sure we'll see more. But I expect to see a lot more in fixed income, a lot more in commodities, and I expect to see that soon. But I'd love to hear what Tom thinks.
Sure, I would definitely agree with that, Matt. And certainly in the fixed income space, I think there's a lot of room for growth there. You know, we hear quite a bit about active ETFs. I still think the jury may be out a little bit on active ETFs, but we've certainly seen some recent filings, including ours, which suggests there's still a lot of interest in that area. So, you know, that may be an area of growth as well.
Absolutely. What about you, Dave?
So, I mean, speaking personally, I think that there are some interesting niche categories that may really just be institutional. They may not be the kind of things that show up as asset classes in someone's asset allocation portfolio. And we've seen registrations for ETFs tracking the credit default swap market. I think that's an interesting one. I don't think a lot of investors are going to be making 10% allocations to CDSs anytime soon. But as trading vehicles, I think those are very interesting. And I do think that we're going to see a rise of more and more what we could call them strategy funds, whether they're actively managed or quantitatively actively managed. Certainly seeing something like PIMCO filing to bring a total return variant to the ETF landscape. I think we're going to start seeing a mirroring of the same kind of breadth of these active and quant active strategies we've seen in the mutual fund space.
I think that's absolutely right. I'll throw in there a few more categories where I think existing ETFs have yet to catch on, but might. One area are those fixed leverage products, which I think are neat and unloved. And they're probably, we generally see a broadening of the number of ETFs that are successful. ETFs that used to be overlooked can now be traded at relatively low spreads, and they're beginning to catch on. I wanted to ask one question to Tom that came in from the audience, which I think is good and important and interesting, which is this. What is more important, a fund's NAV tracking its index or an ETF's price tracking its NAV? I think advisors often get those two things confused. So how should people think about those two separate problems?
That is a great question. And, first off, I think the role of the manager and kind of really their job is to make sure that they track the index, right? So is the NAV tracking the index? And if that's the case, then they're really doing their job. So when we think of tracking error, that's what we think, the difference between the NAV return and the index return. And then there's this the market return that kind of floats around that NAV. So we talked a little bit earlier about, is the fund trading at a premium or a discount, and some of the causes for that, and Dave touched on that quite a bit, I think, and brought up some really good points, especially when you're looking at more esoteric or corners of the market that are more difficult to manage. So I would think first off, from a buyer or somebody looking to buy an ETF, I would certainly look at the NAV to index and see if the manager is tracking tracking the index well, and the ETF is doing what it should be doing, it's meant to do. And then around that, I'd look at the premium discount as well and see, if there's something extreme there, then you have to question what's going on. Why is there bigger premium or discount for this fund relative to maybe some others? And it may be just the case that it as Dave mentioned earlier, it could be the asset class or for other reasons. But the first thing I would definitely look at is the NAV to index.
Yeah, let me follow on that. Are there some areas of the market like munis where the ETF mechanism, maybe breaks down? Are the premiums and discounts too large in an area like munis to make funds viable options in that space?
No, our experience is that munis have, and our muni ETFs have performed very well in this space, and they've done pretty much exactly what we thought they would do. They've grown fast. They've been viable products. They bring liquidity and transparency to the market, and obviously this is a less liquid and more opaque market. So we did see wider discounts in the muni market as the muni market came under selling pressure, and as you, I'm sure, remember, towards the end of the year, it was really the fourth quarter of 2010. But we believe that, mainly these selling pressures were caused by the overall markets themselves. And for the most part, I think ETFs reacted accordingly. There were discounts that happened, but for the most part, I think APs came in and arbed away the difference. So if you look, for instance, at our Spider Nuveen Barclays Capital Muni Bond ETF, and its ticker TFI, it's currently trading at only a slight discount at about 30 basis points, which, with some exceptions, has traded right around that, 30 basis points or even less. So I do think that, in some regards, this is where manager skill comes in, right? So if you have a manager with skill and experience within, these types of markets and the bond markets themselves, and if we look at TFI again, it tracks an index that holds more than 18,000 bonds, which is the Barclays Capital Municipal Managed Money Index. So TFI is optimized. It holds only around 290 bonds or so, but yet if you look at the tracking error for the year 2010, it was only 26 basis points, and 20 of that can be accounted for by the expense ratio. So, you know, a couple points there. I think for the most part, the muni ETFs have performed pretty much as expected.
But you highlighted the issue of the AP coming in and stepping in and doing their job to arb out these sort of price inefficiencies in terms of what investors see on the tape. We actually have a couple questions along these lines. You know, we're guilty of this ourselves to some extent. I mean, we report things like daily fund flows, and we talk about number of creation units per day. You know, our headlines on our website will often have things like, you know, 3 billion flowed into S&P 500 funds, or, you know, SPY lost $2 billion overnight. And it can seem a lot like noise. Should investors care about any of this? I mean, does it matter to investors whether or not a fund has a lot of creation and redemption activity, whether there are a lot of APs participating or not? And how can they even know these numbers? How can they even get a handle on whether this is important?
I think to a certain extent, I think they should. I think that, you know, the fact that APs are coming in, I mean, they're the ones that kind of keep the fund in check. So, you know, with that regard, I think it's, you know, if you're an ETF investor and you're looking at that, I mean, obviously, if you're trading in and out of a fund, you're going to trade at that, you know, for better or for worse, you're going to trade at that market level or that price, and that price should, you know, at the end of the day, be indicative of what you want to have exposure to. So, in that regard, I think it does matter.
I'm going to ask a quick question. I'm going to ask it of Dave first and then hear Tom's view. But Dave, what do you think is the single biggest mistake advisors make when they approach the ETF market, to peel back to a big picture?
Boy, probably trusting data without checking it. I mean, and that sounds like a wonky, you know, something the director of research will say, but I mean, we've seen so many cases where people will, you know, send us a chart and say, how could I ever invest in you know, in LAG? It's doing terribly. It's returned 3% over the last 7 years. And they're simply not looking at total returns. They're looking at price, right, which in bond index obviously isn't going to do much for you. Or even more to the point, they'll go to some a website of maybe a smaller issuer that's not keeping their pages up to date, and they'll pull down a portfolio that might be a month old and assume that that's still the same, right? I mean, you really need to be questioning all of your data and putting all of your ducks in a row before you start this process of going through and looking at efficiency, tradability, and fit. I mean, I think advisors are used to doing that to a certain extent on the mutual fund side of the business, particularly when they're trying to assess you know, the quality of an active manager in the old 1990s style pick a mutual fund manager. They're used to that idea of going and actually looking at who managed the portfolio and really digging in and reading an annual report and seeing what the market opinion of the portfolio team is. Just because ETFs are generally more passive vehicles doesn't mean they should be given less scrutiny.
Good answer. Tom, what about you? What's the single biggest mistake you worry advisors make when they approach the ETF market?
I would agree with Dave. I think, you know, most of the mistakes are likely from not doing due diligence and you know, on some items that we just referred to, like, you know, knowing the provider, the cost of the ETF, what's, you know, what the expense ratio is. Obviously, you know, look at that, but, you know, bid-ask spreads, tracking error, these are things that that you should be looking at. And, you know, I spoke about earlier, and I really do believe this, is that knowing that the index and the underlying index and what's under the hood of the ETF and what's really contained within it, and the construction, the methodology, the rules around the index, and make sure that matches the exposure that you're looking for, and make sure that you have a manager that can give you the exposure that you want.
Interesting. Interesting. Dave, any last questions?
Yeah, I mean, I think we'd be remiss if we didn't answer at least one question like this. You know, there have been a few questions in Q&A, and I had some of my own already. You know, we saw a bunch of reports over the last year or two talking about structural risks in ETFs and how the nature of how ETFs work with creation and redemption could lead to sort of strange run-on-the-bank scenarios where funds had to redeem more than was actually there. You know, in the midst of all that, there was a lot of falsehood, but there was also a lot of sort of genuine concern. I mean, are there things that ETF investors should be worried about when they're analyzing an ETF? Are there risks that might not be obvious from the fact sheet?
I can jump in with a quick answer from my perspective, and I think the answer to that is of course yes. I mean, I think those risks are both either overlooked or vastly overstated. There doesn't seem to be a rational assessment of them. But for instance, securities lending can be a risk. Now, it's a small risk, but it can be a risk. ETFs holding derivatives in their portfolio obviously take on some measure of risk. Again, it's a small risk, and people are too fast to assume that, say, a swap-based fund is the equivalent in credit risk to an ETN. It's not. It's smaller, but there is substantial risk, right? The currency products, the straight currency products are held on demand deposit in London. They're not insured. Right? If something terrible went wrong with J.P. Morgan, those funds would face some issues. Right? Again, that's a small risk, but it's a risk people don't necessarily get to or evaluate fairly.
Tom, any thoughts on that question?
Sure. Just to quickly add to that, I definitely agree. I mean, Matt mentioned the securities lending, derivatives within our products. Not specifically ours. We don't have derivative-based products, but you know, the contango issues that we've seen in that space. Obviously, currency risk. If you have exposure to an exchange-traded note, there's you know, potentially credit risk there as well. And something that we haven't talked about in a while is the leverage and inverse funds that, you know, we've seen some of the risks that have been posed in the past with those, and just having awareness of how those trade and how those funds work are some things that come to mind for me.
Great. Great answer. Well, with that, we've used up our hour. I want to thank Tom Guarini of State Street Global Advisors and my colleague Dave Nadig of IndexUniverse for joining me on this call. Investors interested in more information can go to either of our websites, IndexUniverse.com or Spiders.com. Great resources on both. ECS is at IndexUniverse.com/ECS. For those of you who attended this webinar live, you will receive an email from us in the next few days with directions on how to listen to a recording of this webinar, as well as how to access the slides. That email will also include information about how to qualify for CE credits and how to submit those qualifications. I want to thank everyone for taking the time to listen to our webinar. Join us again for the next IndexUniverse webinar coming up in a few weeks. Thanks, everyone. We'll see you soon.